How Bubbles Arise. Robert Shiller, in Irrational Exuberance, describes bubbles in terms of the positive feedback loops. A bubble starts when any group of stocks, in this case those associated with the excitement of the Internet, begin to rise. The updraft encourages more people to buy the stocks, which causes more TV and print coverage, which causes even more people to buy, which creates big profit for all the Internet stockholders. The successful investors tell you at cocktail parties how easy it is to get rich, which causes the stocks to rise further, which pulls in larger and larger groups of investment. But the whole mechanism is a kind of Ponzi scheme where more and more credulous investors must be found to buy the stock from the earlier investors. Eventually, one runs out of the greater fools. Even highly respected Wall Street firms joined in the hot air float. The venerable investment firm Goldman Sachs argued in mid-2000 that the cash burned by the dot-com companies was primarily an investor sentiment issue and not a long-term risk for the sector or space. As it was often called, a few months later, hundreds of Internet companies were bankrupt, providing that the Goldman report was inadvertently correct. The cash burn rate was not a long-term risk, it was a short-term risk. Until that moment, anyone scoffing at the potential for the new economy was so hopeless would dumb this to the same thing, envy of all those profiting from it. As the chart below indicated, the Nasdaq index, an index essentially representing the high-tech new economy companies, more than tripled from late 1998 to March 2000. The price-earnings multiples of the stocks in the index that had the earnings soared to over 100. And the Nasdaq Composite Stock Index, July 1999, July 2002, and the graphs show me in around the 2000 figure in before the 1999 June, and then some soared and some the figure hit the 5,000, and then the plunges so more and more in 2002 June, so under the about 1,600 figure. Upward scale high-tech bubble. At the bubble's height, scoffers were as hard to find as the Maytag repairman. Surveys of investors in early 2000 revealed that the expectations of the future stock returns ranged from 15% per year to 25% or higher. After all, since 1982, the stock market had produced greater than the 18% returns, and for companies such as Cisco and JDS Unipass, widely known as the producing the backbone of the Internet, 15% returns per year are considered a slam dunk, but Cisco was selling at a triple of earning and had a market capitalization of almost 600 billion. If Cisco grew its earn at 15% per year, it would still be selling at a well above our average multiple 10 years later. And if Cisco returned 15% per year for the next 25 years, and the national economy continued to grow at 6% over the same period, Cisco would have been bigger than the entire economy. Obviously, there was a complete disconnect between the stock market valuations and any reasonable expectation of future growth, and even blue chip Cisco lost over 80%, no, 90% of its market value when the bubble burst. As for the JDS Uniface, the following chart plots its prices against the Nasdaq index from mid-1997 through the mid-2002. By comparison, the bubble in the overall index is hardly noticeable. Comparison of the JDS Unipass stock with the Nasdaq Composite Index, July 1997, July 2002, and that graph will show me some person start from the person before the 1998 June and surge up over some 3,000% and plunge down until the June 2002. Let's keep going. Stocks of the companies such as Amazon.com and Priceline.com, the drum majors of the internet paradigm, rose to dizzying heights. Amazon, with the relatively modest revenues from the book sales and with large losses, sold at prices that made its total market capitalization, the price of its stock, tripled by the number of shares, larger than the total market value of all the publicly owned booksellers such as Barnes and Noble. Jeff Bezos, Amazon's CEO, was Time Magazine, 1999, Person of the Year, the Priceline, an auction company whose site sold empty airline seats while losing buckets of money, sold at the total market capitalization that exceeded the combined capitalization of all the major air carriers. The mania for the internet relative to stocks seems to know no boundaries. The disastrous result for the investors, even in the leading new economy stocks, is shown in the table that follows. The follows shows how even the leading new economy stocks renewed the investors. Thus, Amazon.com, Cisco System, Corning, JDS Uniface, Lucent Technologies, Nortel Networks, Priceline.com, Yahoo, and so on. And in the name game during the tonics boom, all manner of companies added the suffix the tonics to increase their attractiveness. The same happened during the internet mania. Dozens of the companies, even those that had little or nothing to do with the net, changed their names to include web-oriented designations such as .com, .net, or Internet. Three researchers from the Purdue University, M. Cooper, D. Dintrup, and P.R. Rue, studied the 63 companies that changed their names in 1998 and 1999 to include some web orientation, measuring the price change of the companies from 5 days prior to a name change. When word of the change began to leak out, 5 days after the change was announced, they confirmed a remarkable effect. Companies that changed their name enjoyed an increasing in price during that 10-day period that was 125% greater than that of their peers. This price increase occurred even when the company's core business had nothing whatsoever to do with the net. In a later paper examining the post-bubble period, the authors found that the stock prices that benefit when the .com was deleted from the firm's name. An example of the complete insanity that gripped the market, an insanity that went well beyond irrational experiences, is the case of the Palm plot. The market of the personal digital assistants (PDAS) Palms was owned by a company called telecom, which decided to spin off its shareholders. Since PDAS were treated as a sine qua non of the digital revolution, it was assumed that the Palm plot would be a particularly exciting stock. Little did the telecom know how strongly the market would react. In the early 2000s, telecom sold 5% of its share in Palm in an initial public offering and announced its intentions to spin off all the remaining shares to the telecom shareholders. Palm took off so fast that its market capitalization became twice as large as that of telecom. But remember that the telecom still owned 95% of Palm. It turns out that the value of 95% of Palm was almost 25 billion greater than the total market capitalization of the telecom. It was if all of the telecom's other assets were worth a negative $25 billion. If you want to buy the Palm plot, you could have bought telecom and owned the rest of telecom's business for minus 61 per share. I mean the $61 per share. And as mindless search for the riches. The market created the anomalies that were even stranger than the fraudulent accounting practices that were soon to be the real reward. Next paragraph. An unprecedented new-ish craze. In the first quarter 2916 venture capital firms invested $15.7 billion in 2009 startup internet companies. Many are playing to catch up on astonishing 159 initial public offerings (IPOs) had been successfully completed in the previous quarter. It was as if the stock market was on steroids, as happened during the South Sea Bubble, when companies that received the financing were observed. Almost all turned out to the dot-com catastrophes. Consider the following examples of internet startups. Digicent offered a pre-pro you could plug into your computer that would make website and computer games smell. The company ran through the millions from the venture capitalists trying to develop such a product. Flows offered an alternative currency, flows that could be the email to friends and family. It was not quite money, because there were only a few places you could use it, but it is sure made a unique gift. In order to jumpstart the company, the Fleece.com turned to an old business school maxim that any idiot can sell a $1 bill for 80 cents. The Fleece.com launches a special offer to American Express Platinum card holders, allowing them to buy the $1,000 of the Fleece currency for just $800. Shortly before the declaring bankrupt, Fleece itself was fleeced when Filipino and Russian gangs bought 300,000 of its currency using stolen credit card numbers. So consider Pet.com a real dog if there ever was one. The company had a socks puppet mascot that starred in its TV commercials and even made an appearance at Macy's the Thanksgiving Day parade. Unfortunately, the popularity of its mascot did not compensate for the fact that it's hard to make a profit individually shipping low-margin 55-pound bags of the kibble. The names alone of many of internet ventures stretches credulity. Bunions.com, Crayfish, Jeb.com, Godjax, Frogdog, Fatbrain, Jungle.com, Scout.com, Leleki.com, and more. Moreover.com, and then there was the Ebsboard.com, which produced internet pages called it the toilet paper to help you get the poop. Sorry. On the online communities, those are not business models. They are a model for business fear. So Philip J. Kaplan proved to be the brilliant chronicler of the stupidity of the new dot-com financing, deciding to kill some time during a Memorial Day weekend just after the bubble deflated. He set up a website, F-word some companies.com, that offered the latest gossip about the sinking dot-com to companies, as well as a betting pool on when the companies would go under. The website could be accessed by the filing in the explorated characters consorted above. The site attracted 4 million viewers. Kaplan then published a book named after the site, where he ridiculously 100 of the most ridiculous of the dot-com business ideas. Here's how Kaplan described the frame out of the swiftly.com. So let me get this straight. I send them a CD. They give me useless slipped bucks. They go out of business. I get nothing. Great, sign me up. Swapit.com was brilliantly the stupid idea. The promise was that the people could use the CDs and the video games with on another to buy the physically the mailing their crap to the wipeit.com. Users would then be issued the Swapit bucks that they could use to buy other people's crap that have also been sent to the company. eBay's entire success is based on the fact that they have no inventory. By dealing with all the inventory and fulfillment, Swapit is like all of the crap with none of the benefit.